So many economists are saying the stock market investors shouldn't panic, but intensifying U.S.-Iran tensions bring home the potential for geopolitical turmoil to make for more volatile price action in 2020. My guest here is Zach Abraham. He's the Chief Investment Officer with Bulwark Capital Management in Seattle. So, Zach, thanks for talking about this. When it comes to Iran and the potential effect on equity markets, what are you telling your clients right now?
I think one of the biggest mistakes that people make when looking, especially at geopolitical situations or any type of big changes in any type of big events, is I think that you've got errors on both sides. I think you have the people that sit there and go, okay, this is it. The sky is falling. This is why you have to put 100% of your money in gold, or, you've got those guys. Then you've got the other guys on the other side of it who are saying, oh, this will blow over. There's no threat at all. And the reason those guys think that, and when it ends up being a real threat, they get called Pollyannas. But the reason those guys think that is typically of all the bad things that can happen, not, as a percentage, not many of them play out. The one thing that is interesting to us about this is that I think that there's a little bit of whistling past the graveyard here. And I am not saying that we think this is going to turn into some exogenous disaster, military conflict. It doesn't surprise us that Iran is resorting to such aggressive rhetoric, because when you dig down to the surface, that's about all they've got, right? It's tough talk. I think that they know that a frontal military conflict with us is a problem. But on the flip side of that, I think one of the things that concerns us is one of the hallmarks of this longest bull market in U.S. history. Not one of the hallmarks, the hallmark, the watermark of it has been central bank activity, and most importantly, central bank, well, what we like to call collusion. I think central banks would call it cooperation. But flooding markets with liquidity. And anytime you have a significant geopolitical issue like that, it has a tendency to divide things, right? To get people on one side or the other, and dampen cooperation. And so I think that in of itself is the big risk. The other thing is that I think one of the other biggest threats to this whole situation is that geopolitical issues tend to ignite currency issues and currency competition and currency valuations. And that could be a big issue. For instance, if you have an economy that's growing somewhere in the 2.5%, maybe high side 3, but let's call it 2 to 2.5 because that's been the most reliable level. And all of a sudden, oil jumps up 30 or 40%. You're lying to yourself if you don't think that's going to hit economic activity. And what happens if that precipitates, further weakness in the dollar? And how is the Fed going to respond to that? And then if weakness in the dollar becomes an issue, how does the Fed justify continuing to keep interest rates as low as they are? So my biggest thing is, I don't think there's any reason to overreact. I think, like I've been saying for the last 2 years, I think that if there's a happy medium, I think situations like this should remind you that asset allocation is very important, especially when you've seen markets run this long and you've got 6 stocks right now that will make up 23% of the weight of the S&P 500. And people are way over allocated to tech on a historical basis because it's run. And I get it. That's the only thing people want to talk about because it's what's worked. But I think that situations like this, you never know if they're going to play out. You cannot predict how ugly they're going to get. Typically, if you played out the averages, they blow over. There's some type of benign resolution. But when they come at the end of cycles that have lasted this long with this much excess, I think at the very least they should serve as a reminder to people that, hey, guys, there is risk out there. There's risk out there that can, right now everybody feels bulletproof. Nothing. I was joking the other day with a client that I'm calling this the Titanic market, meaning that only God can sink the S&P 500 at this point. That's the way people are feeling. I think at the very least it should remind people that they're not bulletproof, that asset allocation still matters and risk management always matters.
Zach, finally, the Secure Act is now a reality, which is an attempt to fix some of the income challenges with 401ks by allowing annuities to be used inside them and adjusting the contribution limits and RMD age requirements. What's your take on this?
In general, I think it's a good thing, especially the raising of the RMD age. I don't think there's anybody that can find any downside to that other than, IRS IRS collectors out there. They, might dampen their mood a little bit, but in general, I think it's a very good thing. I think we talk about this on our show a lot, Scott, and that is that although not nefarious, meaning that the intentions aren't bad going into it, that so much of the modern investment idea or the modern investment go-to playbook, it's a ton of marketing. And all these guys out there, we just find it so ironic that these guys out there, I've had debates with some of these guys on air, and they're typically pretty vapid arguments. There's all these annuities inside of these 401ks, and it's a disaster. And I sit there and I'm like, okay, so you're griping about something that, costs less, makes more money, and has zero risk of loss. You're griping about that, laying that next to a bond portfolio that's underperformed long-term CDs for the last decade. It doesn't make any sense. And I think a lot of the hand-wringing people hear about this is going to be from the financial industry itself, because this will dent the amount of fixed income they're able to sell, the amount of bonds they're able to sell, because people are starting to realize that this is a phenomenal bond replacement. The other thing is I think that we need to really get out there in the public conscious the difference between a fixed indexed annuity and a variable annuity. It's amazing to me. I hear disaster stories about annuities, and about 1 in 10 are an FIA, 9 in 10 or a fixed index annuity, 9 in 10 are a variable annuity. And when I hear the disaster story about the fixed indexed annuity, it's about that it didn't perform well compared to the S&P 500. So that immediately tells me it was sold wrong. Yet when you compare it to a variable annuity, there are massive issues with variable annuities, and quite honestly, I haven't seen one in a significant amount of time that's worked out good for a client. And if you're going to allow variable annuities into these plans, the fixed index annuities are an infinite better selection on average. And I think it just matters. I think it comes down to your administrator, the research they do, the products they make available, and the way they explain them to people. But if you're going to make variable annuities available inside of plans, you're insane to not include fixed index annuities. On average, fixed index annuities are much better investments than variable annuities. So all in all, I think it's a good thing.
That's Zach Abraham in Seattle, and this is Retirement News Online.